A very good morning, friends. So I hope you're all doing well. Well, today we're going to start with a very interesting standard, and it's a very easy standard as well, and interesting at the same time. I would say it's a part of the series of asset-related standard, because when you're doing standards which are dealing with assets, we got a couple of standards which deals with asset-related standards. So Ind AS 16 is one of them, that is property, plant, equipment. And a similar kind of standard, why I say similar kind of standard, because a lot of parameters which are given in Ind AS 38 are quite similar as compared to Ind AS 16. Ind AS 38, let me first of all tell you the name of the standard. It's called intangible assets. Like, for example, if you look at Ind AS 16, it tackles the area of tangible items. I very carefully use the word. I never said it's tangible assets in terms of Ind AS 16. I said it deals with tangible items. And as far as Ind AS 38 is concerned, it deals with intangible assets. Now, at this stage, one thing is also very important to tell you before we start with this particular standard, that the basic rule which comes is that if you're dealing with assets which are tangible in nature, we're going to cover them in Ind AS 16 provided other parameters are met. And if you're looking at assets which are intangible in nature, we would cover them in Ind AS 38. But what about those assets which might be a blended element, where there might be both a tangible and an intangible element? How do you tackle those particular assets? Well, in those particular cases, you'll have to see that if there is a tangible and intangible element, you need to see what is the predominant level. Is the tangible asset of the tangible element of the asset more predominant in nature? Then it would get covered under Ind AS 16. Now, let's say, for example, if the intangible element becomes more predominant in nature, then it is covered under Ind AS 38. So this is one basic principle we need to keep in mind as we start the standard. So I think let's make a small note to begin with at this stage. So I would say that if you're focusing in terms of items, and we say that they are supposed to be purely tangible in nature, then if the other parameters are met, then we're going to cover this under Ind AS 16. And if you say the item is purely intangible in nature, then we're going to cover this if other parameters are met. It's covered under Ind AS 38. And as I said, if you've got items which has got both the tangible and the intangible elements, then the pertinent question to ask yourself is that which one is predominant? Which element is predominant? So let me put it like this, that which element is predominant in nature? So depending upon which element is predominant, if we say that the tangible element is predominant, then we're going to cover under Ind AS 16, provided, of course, other parameters are met. And if you say it is intangible in nature, then we're going to cover in Ind AS 38, provided, of course, the other parameters are met. So this is how we can say the asset-related standards have been, segregated. That if it is purely tangible, you're covered under 16. And if it is purely intangible, you're covered under 38. And if it is a mixed element, you need to see the predominant level. I know what is now coming to your mind. So can you give examples where there is both the elements and the predominant level is tangible or intangible? Well, let's say, for example, if you look at a laptop, for example, the laptop is got both a tangible and intangible element, but we always consider that the tangible element of the laptop is more predominant in nature, and the laptop is covered under Ind AS 16. Now, for example, if you consider that there is, let's say, for example, a software which is contained in a compact disc, it is compared in a CD, then we would say the intangible element is more predominant in nature. And in this particular case, we would say that it's covered under Ind AS 38. So we're not saying that the item has to be completely intangible to be covered under this particular Ind AS. If it is a blend of tangible, intangible, but what is important is that the intangible element is predominant, then it gets covered under Ind AS 38. So I think that was a very simple background to begin with, just to make a distinction between the Ind AS 16 and the Ind AS 38. Okay, so now I think let's take it forward. Good morning, Soham. Good morning, Nidhi. Good morning, Manini. Good to see you back. Okay, now, as I'm going to start with this standard, I have a little, unique style of dealing with this standard. And what I have done, I've just converted the standard again on an overall basis on a 3-step model. So on a macro level, when I look at this standard, I've segregated this standard on a 3-step model largely. And then we're going to see the inner details under each step. Now, let me first of all give you the framework in terms of how I look at this standard in terms of a practical application and even from an examination perspective. Well, I have divided this standard into a 3-step model. You can maybe note this down as well. So we've got a total of 3-step model in which I'm going to tackle this standard with you. Well, at the first instance, let me first of all tell you that when you look at asset-related standard, I'm not talking of Ind AS 38 in particular, but I'm talking in terms of asset-related standards in general. Mind the words carefully. I'm saying things right now which is supposed to be a generic rule in terms of any asset-related standard. There is a definition, for example, a definition of an intangible asset, and there is a recognition criteria. There is a recognition criteria which is given in the standard. So if, for example, if you meet the definition of an intangible asset, you also need to meet the recognition criteria as well. So if you just meet the definition, and let's say, for example, you don't meet a recognition criteria, it cannot be reflected as an asset in the balance sheet. For an intangible item to be reflected in the balance sheet of the company, what is important is you meet both the definition and you meet the recognition criteria. Once you meet both the definition and the recognition criteria, only then you can reflect the item as an asset in the balance sheet. And I think at this stage, let me draw your attention also to the recognition criteria which is given in the standard. And I take you to the study material. And in the study material, if you notice, we are given, I'll just share the page number to you. So this is the page number 7.355. Ind AS 38 study material page 7.355, where you're given the recognition of intangible asset, and very clearly it says about the general principle. Provided an item meets the definition of intangible asset, it should be recognized in the financial statements if and only if the two conditions A and B are met. And if you look at the condition A and B, it very clearly says it is probable that expected future economic benefits attributable to the asset will flow to the entity. And then it says, and the cost of the asset can be measured reliably. Now, I can tell you one thing, friends, 100% guarantee. When you look at a recognition criteria for certain asset-related standards, for example, if you look at Ind AS 16, or for example, if you look at Ind AS 38, or for example, if you look at Ind AS 40, trust me, the recognition criteria which you can see is exactly the same in all three standards. And even in terms of Ind AS 16 or Ind AS 38 or Ind AS 40, remember, just meeting the definition is not important. Before a company can capitalize it as an asset in the balance sheet, you need to meet the definition and you also need to meet the recognition criteria as well. So I'm particularly giving a lot of emphasis on this because there is a general belief that people believe that if you meet a definition, then it can be reflected as an asset in the balance sheet. And I said, no, the definition and the recognition criteria both are equally important. So that is my first focus in terms of step number one. As we're going to start with Ind AS 38, my step number one would be to see, do you meet the definition and the recognition criteria? Now, a little caution, friends, at this particular stage. Now, when I'm going to deal with the step number one, let me tell you, I'm not directly going to take you to the definition and the recognition criteria. Not all items of expenditure are to be evaluated on the basis of definition and recognition criteria. Interestingly, if you look at Ind AS 38, I call a negative list. I call this as a negative list. There are certain items of expenditure wherein Ind AS 38 has made a specific prohibition. They very clearly said that these items of expenditure cannot be reflected as an asset in the balance sheet, and I call it as a negative list. So when I look at the step number one, before I look into the definitions and the recognition criteria, I would first of all focus on, is this item related to the negative list? Because if the item is related to the negative list, then it cannot be capitalized in the balance sheet. There is no need of looking at the definition and the recognition criteria. So at the first stage, we'll deal with this negative list with you. That what are the items of expenditure which cannot be capitalized as an asset in the balance sheet? If that given expenditure is not a part of my negative list, then I'll go to the definition and the recognition criteria. Okay, the second step now. Once you are done with the step number one, you've identified that yes, the definition and the recognition criteria is met. Then the second important agenda which comes is regarding the measurement aspect. That now you are going to reflect this asset in the balance sheet of the company, but what is the value at which it would be shown in the books of accounts? So we're going to deal with two aspects. One is the measurement at the time of initial recognition. So when you initially recognize an intangible asset in the balance sheet of the company, what is the value at which it is recorded at? And we are also going to look at the subsequent measurement as well. That is, on each balance sheet date, what is the value at which the asset will be recorded? And I think it's good enough to tell you at this stage that intangible assets at the time of initial recognition is always recorded at cost. So when you record the intangible assets initially, it is always recorded at a cost model. But as far as subsequent measurement is concerned, the standard has given us an accounting policy choice. The company has got a choice of recording the asset either at a cost or at a revaluation model, exactly the way we've been allowed in terms of Ind AS 16. Now, once the second aspect is done, that you've measured the asset and we've seen the aspects in terms of initial and subsequent measurement, then comes my step number three, and that talks about the amortization of these intangible assets. Like, for example, if you look at tangible items, they are supposed to be depreciated. But when you look at intangible items, they're supposed to be amortized in the books of accounts. The standard discusses what are the principles for amortization of intangible assets. And then we will also talk in terms of certain impairment aspects related to the intangible assets. So it's a very simple three-step model to begin with. This is just to give you an overall picture how we are going to crack this particular standard. So at the first instance, we're going to look at the definition and the recognition parameters. Then we're going to go to the measurement aspects, initial and subsequent. And then finally, we're going to deal with amortizations and the impairment of intangible assets. I hope, friends, my framework of thought is pretty clear to you. So I've just given you two things so far. One, I've just shared with you that the focus right now is on items which are intangible in nature. Because if you're looking at items which are tangible, then you've got Ind AS 16. If you're looking at items which are intangible, then it is Ind AS 38. And if you're looking at items with a blend of tangible, intangible element, we need to see which one is more predominant in nature. And accordingly, we apply the given standard. And the second thing which I've given you is regarding the steps, the three-step model we're going to apply in order to crack this particular standard. So I hope, I trust that you're clear with this particular aspect. Okay, Shobham tells me, so three-step models are back. Yes, the three-step models are back now. Okay, so now with this input, let's, I think, take this further. Now, I'm going to, first of all, as I said, go on a step-by-step basis. So I am starting with, first of all, my step number one. Now, it's going to take some time before I give you a concrete inputs as far as step one is concerned. So I think you'll have to allow me another 15, 20 minutes or so, and then we'll be able to get something very concrete. So almost in around a half an hour or 45 minutes, we'll get a complete picture in terms of step number one, and we'll do a couple of questions as well. You'll get to know the entire concept with logics as well. So I'm coming to the step number one, where I said you need to look at the definition and you need to look at the recognition criteria. So we need to look at the definition and the recognition criteria. You need to meet the definition characteristics and you need to meet the recognition criteria before you can show this item as an asset in the balance sheet of the company. Now, I'm not going to take you to the definition right now. I'm not going to take you to the recognition criteria, but what I'm going to tell you, I'm going to give you that negative list which I was talking of. As I said, I have a little different way of looking at the standard. So what I'm going to do in step number one, I'm going to go to certain sub-steps. So what I'll do, the step number A, I'm looking at the sub-steps in the step number one. I'm going to look at the step number A, wherein I'm going to first of all put a question to myself. And that is the item, please note the notes as well, is the item a part of the negative list? Is the item a part of the negative list? So the first thing, what I'm going to do, I'm going to see that is the given expenditure a part of the negative list. So if you say yes, it is a part of the negative list, then the item of expenditure is outrightly revenue in nature. Then the item of expenditure is revenue in nature outrightly. And if you say no, it's not a part of the negative list, then I'm going to go to the sub-step number B, simple and straight. So all you need to do is just look at the given expenditure and see, is it a part of the negative list or not? Then in terms of the step number B, now what I'm going to do, I'm going to now look at that are the definition and recognition parameters met? Are the definition and the recognition parameters met? Underline definition and recognition. So we're going to see that are the definition and the recognition parameters met or not. And here again, the answer would be either a yes or the answer would be a no, that the definition and the recognition parameters are met. So if you say yes, the definition and the recognition criteria are met, then I would say it would be capitalized as an asset in the balance sheet of the company. But if you say that the definition and the recognition parameters are not met, then again, it becomes a revenue expenditure. As simple as that, the thought process needs to be very clear. So it's a two sub-step model in terms of the step number one. At the first instance, you need to see that is it a part of the negative list? If it is a part of the negative list, it is outrightly revenue. Otherwise, I go to the step number B, where I look at is the definition and the recognition parameters met. If they're met, it is capitalized in the balance sheet. Otherwise, again, it's a revenue expenditure. Pretty simple and straight. Okay. So I think in the first instance, what I need to take you is on the negative list. Now, let me caution friends at this stage. As I'm going to take you to the negative list, what would come to your mind is, so what is the logic of this negative list? I may not be able to give you the logic right now, because unless we have done the definition and the recognition parameters, we will not be able to appreciate that what is the logic of that negative list. But what I'm doing right now, I'll give you the negative list, and we'll come to the logics later. Once I give you the definition and the recognition parameters, I will come back to the logic of that negative list as well. So the only thing which is going to be pending for the time being is the logic of that negative list. So don't get worried on that. Once I give you the definition and the recognition parameters, we'll get the logic of the negative list as well. So let me now start with the negative list with you. So my focus right now is on the negative list. So what I'm going to do, I am just going to take you to certain relevant areas in the standard. And for this, I'm just taking you to the text of the standard, though you don't need to refer that. You can refer the things in the study material only, but just for the matter of convenience, I am just going to take you to certain paras in the standard. You don't need to remember the para numbers. If you're fond of it, you can do that. Though like I'm quite fond of para numbers, it gives me a different kind of a feeling altogether. But you're not required to remember the paras. I'm just making a walkthrough for the purpose of convenience. So just have a look at these relevant paras with me. Now, the first thing what I'm looking at is in the standard, there is a para number 48. There is a para number 48, and it says on the top of para number 48, internally generated goodwill. It says internally generated goodwill. Mind you, there are two goodwill. One is called internally generated, and one is called a purchase goodwill. Now, the standard in para number 48 clearly says internally generated goodwill shall not be recognized as an asset. I'm not coming to the logic right now. We said we'll discuss the logic later. Right now, we're just giving you a negative list. Now, any company for that matter would never be able to reflect the goodwill, its own internally generated goodwill in the balance sheet. If you acquire somebody's business, let's say, for example, A Limited acquires a business of another company, and it pays a premium in terms of purchase consideration. So let's say, for example, you paid a consideration of 250 crores, and in return, you get a net assets of the company that's 200 crores. So you paid a premium in the form of goodwill. Now that goodwill is supposed to be a purchased goodwill. The standard does not prohibit you in terms of recording a purchase goodwill in the balance sheet, but it says your own reputation, your own goodwill, which is generated over a period of time, is something which cannot be reflected in the balance sheet. And I think during your intermediate study, during your foundation study, you've always been aware that even in terms of partnership concerns, they cannot reflect their goodwills in the balance sheet. The input is same, that Ind AS 38 and even the IGAP, which was there on intangible assets, they used to prohibit a company from reflecting the internally generated goodwill in the balance sheet. So one of the items in the negative list is the para number 48, which talks about internally generated goodwill. One. Now let's take you to the other one, and this is para number 54. Now, para number 54 talks of what we call R&D, research and development. A company would do internally research and development projects. And we have got two phases of R&D. One is called a research phase and one is called a development phase. So when you look at a research phase, the para number 54 clearly says no intangible asset arising from the research shall be recognized. Expenditure on research shall be recognized as an expense as and when it is incurred. So the standard makes it very clear that if a company has got any kind of expenditure, if the company has got any kind of expenditure which is incurred during a research phase, it is simply treated as revenue. Don't worry, friends, on the logic. That's going to come very soon. So when a company incurs any expenditure on a research phase, the para number 54 says, no, it's revenue in nature. So I think we're getting a negative list. I'm pretty sure you've done intangible assets AS26 in your intermediate as well, but perhaps this might be slightly different from the way I'm looking at the standard. Do let me know if this is quite different from the way you looked at the standard earlier. I'm taking you on a different ball game altogether. And I'm giving you a different approach in terms of looking at this very interesting standard. Okay, so after the para number 54, I'm now coming to the para number 57. The para number 57 talks about research and development, and it talks about the development phase. Now, let me caution friends at this stage. In terms of the development phase, I'm not saying that it's a part of the negative list. I'm not technically saying that it's a part of the negative list, because in terms of the development phase, the standard makes it very clear that there are a total of 6 conditions which you need to meet. If you're able to meet all the 6 conditions, then mind the words. The expenditure incurred on the development phase will become eligible for capitalization. You heard my words correct. I never said that the expenditure incurred on a development phase will be capitalized. There is a difference between saying that the expenditure will be capitalized and a difference in terms of saying that the expenditure will be eligible for capitalization. So in a development phase, I would say it's a conditional kind of a concept. There are a total of 6 conditions which are given in the standard, and they say that if all the 6 conditions are met, then the amount incurred on the development phase is eligible for capitalization. And if any one of the condition fails out of 6, any one or more condition fails, then the expenditure becomes revenue in nature. Let me also caution one thing more. As I'm going to take you to the definition and the recognition parameters, let me tell you, in terms of a development phase, we need to look at these 6 conditions rather than looking at the definition and the recognition criteria given in journal. So, once I'm done with entire concept at the end, I'm going to give you a beautiful chart today, depending upon what kind of intangible assets we're looking at and what kind of parameters do you need to fulfill in order to say that is it supposed to be recognized as an asset in the balance sheet or not. So the third focus, which is not a part of the negative list, is the development phase in R&D, where we said that if the 6 conditions are met, the expenditure is eligible for capitalization. And if the expenditure is not met, then in that particular case, it's a revenue expenditure in that case. Okay. And I think Koshki tells me, sir, yes, it's a different approach altogether. Wow. But I think you'll love this approach. Trust me. Now, after the para number 57, I'm taking you to another para, and that is para number 63. The para number 63 is talking of some more examples related to internally generated assets again. It says if the company has got internally generated brands, it has got mastheads, it has got publishing titles, it has got customer list, and items which are similar in substance, they shall not be recognized as an intangible asset. So we're given a couple of list of items which are internally generated in the para number 63 as well. It talks about internally generated brands. It talks about mastheads. It talks about publishing titles. It talks about customer list and similar items. Similar items would be, for example, a market share. A company would achieve a certain market share over a period of time. Now, that market share achieved by the company is something which cannot be reflected as an asset in the balance sheet. So this is another negative list of items in terms of para number 63. And then there is another list which is given in terms of para number 69 of the standard. Para number 69 of the standard also gives us certain more examples of expenditure, which is considered as a revenue expenditure when it is incurred. And there are a list of 4 items which are given in para number 69. It talks about expenditure on startup activities. It talks about the expenditure on training activities. It talks about advertisement and promotional activities, and it talks about expenditure on relocating or reorganizing a part or all of the entity. Like, for example, if you remember when you've been doing questions, maybe in financial management as well, and a company used to incur an expenditure on relocating its factory, the expenditure which is incurred in relocating the factory is something which cannot be capitalized. It's something which is treated as a revenue expenditure. So any kind of expenditure which is incurred initially, for example, when you say startup costs, I would say preliminary expenses for that matter. You would have always remembered that if there are any kind of formation expenses incurred with the company, all those formation expenses, like the preliminary expense, they are the startup cost of the company, and these expenditure need to be immediately written off. I know what is coming to the mind is the logics of all these relevant provision. No worries, we'll be coming to the logics also very soon, that why does the internally generated goodwill, or why does the research phase, or why does the internally generated brands, customer list, etc., what are the parameters which fails, which doesn't allow the standard to capitalize? No worry on the logics. As I said, those will come slightly later. And the list of expenditures in para number 69, your training, your advertisement, your preliminary expense, your relocating expense, they're all a part of the negative list. And trust me, that's all. That's all. So if you technically ask me, what is the composition of the negative list? So I would say the negative list is comprising of, typically, if I just recall the para numbers, I would say it is para number 48, dealing with internally generated goodwill. It is para number 54, dealing with the research phase in R&D. And I would say para number 57, but this is not exactly a negative list. It is a conditional list. So para number 57 would be applicable if you fail any one or more of the 6 conditions. Then there is a list in terms of para number 63, and there is a list in terms of para 69. Now, the life is simple. You see, if I am very clearly given a list of these items which are treated as revenue, there is no need of applying the definition and the recognition criteria. The moment you get a question in the exam and we know that it relates to the negative list item, I can always outrightly say that it is revenue in nature. And I could also support the fact that, the Ind AS 38 specifically prohibits the capitalization of such an expenditure. And trust me, even in the subsequent para numbers, like in para number 49, you are also given the logic of why the standard prohibits the recognition of these items as an asset. So you can tell the examiner in these cases that this is the reason, and the standard specifically prohibits the capitalization. So we've got a basic feel of the negative list without any logics. I hope I am fairly clear so far at this stage. Okay, now moving forward with you, once we've done the negative list, now it's time that we look at the definition and the recognition parameters. So once I'm going to look at the definition and the recognition parameters, then I'll give you the logic of this negative list as well. So no worries on the notes. The notes will come a little later, but let me still give you, first of all, one words at this stage, so that don't remember the para numbers, at least you're able to relate to what this is relating to. So the para number 48 is relating to internally, generated goodwill. So at least that negative list is clear with you, that internally generated goodwill. We'll do a couple of questions from the study material also, once we're done with the definition and the recognition parameters, so no worries on that. The para number 54 is dealing with the research phase. It is dealing with the research phase in R&D. And the para number 57 is dealing with the development phase in R&D, which is conditional in nature. And the para number 63 is dealing with a couple of items, like, for example, it is talking about internally generated brands. We'll give you some more appropriate notes later. So internally generated brands. So we've got internally generated brands, for example. We've got methods. I hope you know what is a methods, because nobody asked me what exactly is a methods. I presume that you know what is a methods. Then there is customer list. Then there is a customer list. And then it says publishing titles. So a couple of items are given in this para number 63, publishing titles. And then it says similar items, and similar items, I would put it as market share. So if you're able to develop a market share over a period of time, so these are all expenditures which are prohibited under para 63. And if you look at the list of items which are given in para number 69, so I would say in terms of para number 69, we've got preliminary expenses. We've got items like a training expenditure. We're going to discuss more about this training expenditure because there have been some very interesting clarifications which are given in the education material, because there has been an education material released by the institute, and that's by the Accounting Standard Board. And there has been some very interesting clarifications in the education material on the training, which I'll come to that slightly later. So it says training expenditure, then any kind of advertisement and promotional activities, or any expenditure which is incurred on relocating the relocating the factory. So all these expenditures are given in para number 69, and they are prohibited from capitalization. Okay, so far so good. So I think we've just made a list of the negative items. That is, these are the items of expenditure where you cannot capitalize the expenditure in the books of accounts. Okay. Now, I think let's take it. And I think now I'm getting questions. Sumit, I think Marani and so Shubham, so what is supposed to be a case of methods? Okay, I think now let's give you input on that, because I think nobody asked me, so I never explained that. You know, when I look at this methods, it takes me back to a little old journey. So I'm going to share my, personal experience on this. I remember a long time back when I was a child at that stage, and I learned this concept of methods, not the technical name, but I learned the concept of what is called a methods at that stage. Now I'm going to tell you something which you're going to remember for life. Because when you tell people certain stories, then I think that is something which people, generally remember as well. I remember as a child, I used to see my grandfather, and I used to see that, he always used to read a particular newspaper. I'm not going to take the name of the newspaper. So he used to always read a particular newspaper, and there were a couple of other competitors coming with new kind of newspaper. And I used to tell him that, why don't you change the newspaper? The world is switching over to different kinds of newspaper. So why don't you also switch over to a different kind of newspaper as well? And then he gave me a reason, why he used to read a particular newspaper. And then he showed me what is called the editorial board of the newspaper. Like, for example, if you pick up any magazine, or like, for example, if you pick up any newspaper, now, of course, these days, you'll not find that mentioned, but at least in magazines, you'll find that on the initial pages itself, they give their editorial board. Who are the people of name and fame who are attached to the editorial board of the newspaper or the magazine? And that is called mastheads. That means over a period of time, you would have created a reputation where people of certain name and fame are getting attached to is called a mastheads. So this is something which is prohibited. A company cannot say that if these people are associated with me, then the composition of my editorial board is something which is an intangible asset to me. So this cannot be reflected as an asset. The logics we're going to discuss very shortly later. Okay, right, friends. So I think so far so good at this stage. I guess everybody is pretty clear till my thought processes so far. I think let me just consolidate my step number 1 at this stage. Before I take you further, let me consolidate my step number 1 at this stage. But I hope we are pretty clear with what is going on at this stage, because I think so far so easy. It's not a very technical standard like financial instruments, which we did earlier. So this is a pretty easy standard, a relief in between. Okay, so now let me come back and consolidate my step number 1 to you. And this time, today I'm using a little blackboard as well, because I feel the handwriting comes a little much better on this board. And I think the visual effect also is much better. You see a little more colors in terms of being used. And I think the handwriting comes a little better. So I thought, let's change the mood with the new standard and let's bring something different to you. So As I said, we're working on a 3-step model in terms of Ind AS 38, and in terms of step number 1, I'm looking at definition and recognition. But there is no need of looking at the definition and the recognition criteria at the first go. So when you're looking at the step number 1, there is a 2 sub-steps which you need to follow. At the first instance, you need to see that the given expenditure, is it a part of the negative list? Now, you know what is comprising of the negative list. As I announce the negative list, just try to announce it in your mind as well. So there is internally generated goodwill. Then there is supposed to be a research phase expenditure. The development phase expenditure is not exactly a negative list, but if the 6 conditions, any one of the conditions fails, then it is revenue. Then there is something which is given and market share, methods, etc. And then there is another list of items, the 5th item, training, advertisement, relocating, preliminary expenses. So we can say there are 5 list of items. You've got 5 fingers in hands. And if you put them together, it gives me a negative list of items. So if the given expenditure is a part of the negative list, outrightly it's revenue in nature. If the given expenditure is not a part of the negative list, then it's time to go to the step number B, and then you need to see, are the definition and the recognition criteria met? Wow. You know what? In the last around 40 minutes, we have just created a background in terms of how we're going to crack this standard. I've not even given you the definition of an intangible assets to begin with. Now, I think we're going to look at the definition and the recognition criteria. Okay, so let's begin the journey. And yes, so let's create a board. Blackboard is better. Okay, wonderful indeed. So I think now let's take the journey forward. Now, as I'm looking at the definition and the recognition, now, my friends, I'm going to now develop this particular concept. I'm going to first read the definition. I'm going to look at the recognition criteria, and then I'm going to make some pinpointers on the basis of which we're going to look at the definition and the recognition parameter. So let me do one thing. Let me just come back to the study material. And I think the first thing what I'm going to look at is the definition of intangible asset. So this is the definition of intangible asset, which is given in the study material on page 7.347. Now, I'm going to look at the definition and just look at the parameters, and I'll give you the explanations after I made a list of my parameters. It says an intangible asset is identifiable, 1, non-monetary, 2, asset, 3, without physical substance, 4. So when I look at the definition of intangible asset, there are a total of 4 important keywords which I look at the definition of the standard. So what I need to do, I need to first of all prove that the item is identifiable, 1. I need to prove that it's non-monetary in nature, 2. I need to prove number 3, it's an asset. And I need to prove number 4, it's without physical substance. I'll give you the explanation later, but I think right now I am ready that my definition has got a total of 4 parameters. If I look at the definition, I can say that there is a list of 4 parameters which need to be met before you say the definition is met. So we need to first of all prove that it is identifiable in nature. And then the second, we need to prove that the item is non-monetary in nature. Don't worry, we'll understand what does it mean. We need to see that it is non-monetary in nature. Number 3, we need to see that it is an asset. And number 4, we also need to consider that it is without physical substance. I'm putting it as WPS, without physical substance. So these are the definition parameters. Then there are also certain recognition parameters as well. And in terms of the recognition parameters, let me take you back on the study material. And we just saw a little while back that what are the parameters of the recognition parameters. Now, I'm going to use a slightly interesting language, which is used in a practical life arena as well. And I'm going to use that practical language right now. So just hear the words very carefully at this stage. Now, on the recognition parameter, this is given. There are two clauses on the recognition parameter. It is probable that future economic benefits are expected. So it says the future economic benefits are probable. When I say the word probable means that there is a 50% plus. I didn't say 50. I said the chances of 50% plus. So there is a 50% plus probability of the economic benefits arising. And the second clause is that the cost can be measured reliably. You know, in a practical life, and even if you look at the nomenclatures which are used in the standard, the first condition, that is probable economic benefits, is called a probability recognition criteria. And I'll put the words as well. The condition number A is technically called a probability recognition criteria. And similarly, when you look at the clause number B, when it says the cost can be measured reliably, it is technically called a measurement criteria. So you can see that in the recognition criteria, it's a blend of a recognition criteria and a blend of a measurement criteria. The clause E is looking at a recognition. When you look at the clause number B, it relates to the measurement. So we call it as a reliable measurement criteria. So we can say that if you look at the two parameters for the recognition, it says number one, that the future economic benefits are going to be probable. So when we say the future economic benefits are probable, there is a more than 50% chance of getting benefits. And the second one is that the cost can be measured on a reliable basis. The cost can be measured on a reliable basis, so it can be measured reliably. And as I said, we technically call them as. In my future discussion, I'll give a reference on this as well. So the first recognition criteria is called the probability. It is called the probability recognition criteria. It is called the probability recognition criteria. And the second condition as a part of the recognition criteria is called the reliable measurement criteria. It is called the reliable measurement criteria. So these are the two aspects in terms of the recognition parameters that you need to consider: the probability recognition criteria. The future economic benefits would arise that there is a more than 50% chances of benefits coming in. And you should be able to measure the cost which is incurred in terms of acquiring, or the cost which is incurred in terms of creating that intangible assets, which is called a reliable measurement criteria. Right, friends? So I think if you add all these conditions put together, the definition and the recognition parameter, I think it makes it a list of 6 items. Wow. So that means we've got a total of 6 items. We can say a total of 6 parameters, on the basis of which you would say that if these 6 parameters are met, only then the item can be recognized as an intangible asset in the balance sheet. Okay. Now I think we need to dig further and identify what does this each of the parameter mean. So what I'm going to do now, I'm going to first of all make you a walkthrough on each of these parameters. What do you mean by identifiable? What do you mean by a non-monetary? How do you decide it's an asset? And I think without physical substance is well understood. What do you mean that there will be economic benefits which are probable in nature? And what do you say when you say that the cost can be measured reliably? Okay, so I guess so far so good. Now I think let's take this further. And I am now going to elaborate on each of these parameters one by one. So let me start my discussions on these parameters one by one. So let me now give you the inputs, and you can start making notes as well on each of these parameters one by one. The very first parameter is given identifiable. The very first parameter which is given is called identifiable. Now, when you look at identifiable, the word identifiable means that it is capable. The word identifiable means that it is capable of being sold it is capable of being sold, or it is capable of being rented, or it is capable of being, let's say, exchanged separately. If the item of intangible asset is capable of being sold, capable of being rented, capable of being exchanged separately, then we can say that it is identifiable in nature. So what is the key word is that it is capable of being sold, rented, or exchanged separately. Now, a small little question which comes to the mind. Can a company sell its business, or rather, I would say, can a company sell its goodwill without selling a business? Can I tell the person that I'm going to sell you my goodwill, but I'm not going to sell you the business? You can't do that. If you sell the business, you sell your goodwill along with the business. So when you sell your business, you sell your reputation also along with it. So that means goodwill of a business is something which is not identifiable. Wow. Does this mean that when I was looking at para number 48 and the para number 48 tells me that internally generated goodwill cannot be reflected as an asset in the balance sheet, is this the logic that the internally generated goodwill is not identifiable? Yes. So we can say, in this case, we can say, if you're looking at internally generated goodwill, in this case, we can say it is not identifiable in nature. It is not something which can be sold separately. You cannot sell a goodwill of a business without selling the business itself. So it's not capable of being sold on a separate basis. And I think, just to make a little more clarity of thoughts, let me do one thing. Let me just take you to the text of the standard and give you the inputs which are given in the para number 49. Below the para number 48, there is an explanation which says in para 49, which gives you the logic of why this particular goodwill is not reflected as an asset in the balance sheet. It says very clearly, if you read in between, internally generated goodwill is not recognized as an asset because it is not an identifiable resource. It says it is not separable, nor does it arise from contractual or legal rights controlled by the entity that can be measured reliably at cost. So the standard makes it very clear that the reason why an internally generated goodwill is not reflected as an asset in the balance sheet is for the reason it's not identifiable in nature. Now, let me also tell you another important inputs at this stage. When you're looking in terms of identifiability, now hear this very carefully, a very important note at this stage. If an intangible asset stems out of legal rights or contractual rights, if your intangible asset is based on a contract, it stems out of contractual rights or it stems out of legal rights, this condition is always assumed to be met. So if I am given in the question that this intangible asset is based on a legal right, it is based on a contractual right, we can say in this case, the identifiability test is always met. There is no need to make any assessment at this stage. There is no need of asking that it is capable of being separately sold or not. If your intangible asset is arising out of contractual rights, or if it is arising out of legal rights, we would safely assume that this test identifiability is always met. So if it doesn't arise out of contractual or legal rights, then you need to make an assessment that can it be separately sold, can it be separately rented or exchanged? If yes, it is identifiable. If no, it is not identifiable. And if it is not identifiable, it cannot be reflected as an asset in the balance sheet. That is the parameter number 1. Now let's take you to the parameter number 2. The second parameter which is given in the definition, is, we said that the item is non-monetary in nature. The second parameter is that the item is supposed to be non-monetary in nature. Now, let me tell you something, friends. And since you've got knowledge on financial instruments, I think now my life becomes even more simpler. There are two kinds of items. One is called monetary. There are two kinds of items. One is called monetary and one is called non-monetary in nature. Now, when you say that the item is monetary in nature, it means that the economic benefits, it means that the future economic benefits which will arise from the asset is going to be fixed. The economic benefits which will be derived from the asset is going to be fixed. But if the benefits derived is going to vary, if the benefits which will come will vary, then it is supposed to be called a non-monetary item. For example, if you consider a case of, let's say, a trade receivable. A trade receivable is an amount which you need to collect from the customer. Now, you would be able to collect only a fixed amount from the customer. When you made a sale to the customer and you gave him an invoice, it entitles you to receive a certain fixed amount of money as well. But let's say, for example, if you look at a property, plant, equipment, more the goods produced out of the machine, more the revenue you will generate, more the economic benefits it will come. So I am just thinking, and maybe you can vouch me on that. I have not read this anywhere, but I think this is what my thought process works on. Is it technically right to say that financial assets would be something which are monetary in nature generally, and non-financial assets would be something generally non-monetary in nature? Just think about this. Your financial assets are something which gives you a contractual right to receive. And they give you a contractual right to receive a fixed amount of money. Whether it's a case of a trade receivable or you look at any other financial asset for that matter. I'm not saying that this is always true, but I'm saying that if you're stuck up in terms of deciding things, one can definitely say that another way of looking at that, if the benefit to be received is fixed in nature, we can say that if it is a financial asset, generally, it would be monetary in nature. If it is a non-financial asset, like for example, if you're looking at inventory, it's non-monetary. Like for example, if you're looking at a PPE, it's non-monetary. Like for example, if you're looking at intangible, it is non-monetary in nature. So any asset which will give you a fixed economic benefits, it is monetary in nature. So generally, all financial assets would be typically acting as monetary. And those assets which will give you a fluctuating, a variable amount of economic benefits is going to be non-monetary in nature. I think you would agree with my idea that financial assets generally would be of that case. And that's rightly agreed. Okay, so we can say for our own understanding perspective, that generally, if you tend to get a little confused on how to look at it, we can say that generally financial assets are monetary and generally non-financial assets are going to be non-monetary in nature. Which is intangible, is something which will give you benefits which will vary. Okay. Now let's come to the third parameter, and the third parameter is in terms of asset. The third parameter which is given in the definition is supposed to be an asset. So my third parameter is supposed to be an asset. Now let's see, how do you identify that the item is an asset? Well, I guess I'm not looking at the exact definition of the asset, but when I look at the concept of an asset, what stems out of the definition of asset is one of the important parameter is control. And the other parameter is that future economic benefit should arise. So when I look at the definition of the asset, what comes to my mind are the two important parameters. When you look at an asset, the first thing, if you want to prove something as an asset, is supposed to be a control. The question rises, how do you prove that there is a control factor? Simple. In order to prove that there is a control, you need to prove any one of the two parameters. Either you are able to prove that there is a legal ownership. If you're able to prove that there is a legal ownership, it automatically proves the fact that there is a control over an asset. And if you can't prove a legal ownership, you should be able to prove that you've got the right to restrict. You've got the right to restrict others. You've got the right to restrict others from use of an asset. You're able to prove that you've got the right to restrict others from use of the asset. So if I am in a position to fulfill any of these two parameters, I am able to prove that there is a legal ownership, or I'm able to prove that, yes, I've got the right to restrict others from the use of that asset, then I would undoubtedly say that I control the asset, because legal ownership is not necessary. Even the right to restrict others from the use of the asset is good. But we can say that the moment you've got a legal ownership, it is very easy to prove the concept of control. And when you say that the future economic benefits would arise, let me tell you, the future economic benefits can come in two ways to a company. When you're looking at a future economic benefits, there are two ways in which a future economic benefits could come. One is in the form of increase in revenue. So one is that your revenues will increase. That's a way of getting a future economic benefit. The other way is that there is a decrease, there is a saving in terms of cost. So when you're looking at an intangible asset, the economic benefits derived from the asset could be in the form of increasing revenue, or the economic benefit could be in the form of decreasing the cost. And I would be able to say that, yes, economic benefits are going to come. Wow. I think the three inputs are done. Identifiability indicates separability. Then the second parameter we looked at was the concept that it's non-monetary, economic benefits will vary. The third one is supposed to be that there is an asset which has got two parameters, a control and an economic benefit. And then comes the fourth parameter. The fourth parameter, which is given in the definition, is supposed to be without physical substance. And I think I've already explained that when you say without physical substance, there could be two situations. Either you tell me that it's purely 100% intangible in nature, or you can say that it is predominantly intangible in nature, or you can prove me that it is predominantly intangible in nature. So either you can say that it's a blend of tangible, intangible, but the intangible element is predominant, or you tell me that it's purely 100% intangible, then the condition of without physical substance is met. Wow. Now comes the parameter number 5 and the parameter number 6, which is a part of the recognition criteria, which I said is the probability recognition criteria. You should be able to prove that the economic benefits arising by way of increase in revenue, or the economic benefits arising by way of saving in cost, there is a more than 50% plus chance. You should have more than a 50% plus probability that economic benefits will arise. And importantly, the measurement criteria, that the cost can be reliably measured. We are in a position to calculate the amount of cost incurred in terms of acquiring the asset, or we can say the cost which is being incurred in terms of creating that intangible asset. So that is a blend of 6 conditions put together. Right, so I think now we are fairly clear, I guess, in terms of the 6 recognition definition parameters. Now, let's make your life a little more simpler. What I'm going to do, I'm going to condense these 6 parameters into effectively a list of another 5 parameters so that life is easy, jingalala. You've got a negative list of 5 items, and I'm going to give you a list of 5 recognition and definition parameters as well. So these 6 conditions, we are going to club them and make it a single list of 5 items in this case. Let's have a look. Now, if you look at the definition, and if you look at the recognition, we had initially started with a total of 4 parameters on definition and 2 parameters on the recognition. Now, I'm just going to list down the parameters again and condense them into a list of 5 items. The first one is identifiable. The first one is identifiable. The second one, as we said, non-monetary. So let me put it as that future economic benefits will vary. Instead of saying non-monetary, let's say future economic benefits will vary. Then instead of saying asset, let's put it as that there is a control and the future economic benefits will arise. Then I have the fourth parameter, which is without physical substance. And then the recognition criteria is the future economic benefits are probable. There is a 50% plus chance. Now you would have already realized what I'm going to do. And we can say that the cost can be measured on a reliable basis. So we can reliably measure the amount of cost as well. Now, I think let's begin the countdown and let's see how many parameters are there. The parameter number 1, is it identifiable in nature? The parameter number 2 has got 3 factors. 2A, will the economic benefits arise? 2B, will the economic benefits arising has got more than 50% chances? And 2C, that the economic benefits will vary. I hope you're clear. So we're looking at 3 factors in economic benefits. They will arise. The probability that they will come is more than 50%, and they will vary. And there are, you can say effectively there are different connotations of these 3 parameters. They will come. That's one thing. Their coming has got a more than 50% chance. You can club A and B together as one of the parameters also, that economic benefits will be coming in and there is a 50% plus chance of the coming in. And we can say the economic benefits will vary as well. Number 3, you can prove a control by way of legal ownership or the right to restrict others from use. Number 4, it is without any physical substance or predominantly intangible. And number 5, the cost can be measured on a reliable basis. So I think I've made a list of 5 parameters in effect when you look at the definition and the recognition parameter. I'm sure this is quite different from the way you looked at accounting standard 26 at the intermediate level. But I think we are making it very scientific and very logical in terms of how you are going to look at the parameters of intangible asset. So let me now consolidate the picture. And I think I am done. Number 1. Now, if I just consolidate the picture and let me see what is there in terms of my step number 1. Now we are on step number 1 and we are looking at the sub-step number A and the step number B. I'm here to give you the logics of that negative list as well. Don't worry, I'll give you the logics after this particular step. So the first thing which you need to do in step number 1 is look at the negative list. Look at the negative list. After this, I'm going to give you a comprehensive, the final version of my first step. I'll give you the final version of my first step after this consolidation. So the first thing is you need to see the negative list. If it is a part of the negative list, then undoubtedly the expenditure is revenue in nature. If it is not a part of the negative list, then you need to go to the sub-step number B. And the negative list is comprising of 5 items. Internally generated goodwill, research phase, development phase, if any one of the 6 conditions fails, internally generated brands, etc., training, advertisement, etc. So if you're in the 5-item list, revenue. If you're not in the 5-item list, you go to the step number B. In step number B, you've got 5 parameters to watch out. Identifiability, economic benefits will arise 50% plus and they will vary, then control, then without physical substance, and the cost can be measured reliably. If you meet all those 5 conditions, it is capitalized. And if you fail any of those parameters, then it is again revenue in nature. Wow. So I think my complete thought process on step one is clear. The only thing pending is the logics on the negative list, which I will now elaborate, friends, to you once I give you the complete picture of my step model. Okay, I think a couple of questions which I think I need to answer now. So when you said why inventory is a non-monetary item, well, when you're looking at inventory, inventory is not going to give you a fixed amount of money. When you're looking at inventory, inventory is going to be sold at a price which is not predetermined, it's not fixed. The money which you're going to realize from the sale of the inventory is not something which is already fixed in nature. So depending upon the market prices prevailing at that point of time, the amount of money which you receive can vary. So it's non-monetary in nature. And Shobham, you said, so why a non-monetary word is used instead of non-financial, which is a nomenclature on the balance sheet phase? Well, we cannot outrightly say that all items which are financial assets would be typically monetary in nature. Like, for example, if you look at, I think, let me give you the example as a very valid question. I think let me now give you a little more clarity on this. When you look at investments for that matter, investments in terms of financial instruments is financial asset, whether it's an investment in a debt investment or whether it's an investment in equity investments, they're both financial assets. But if you look in terms of, monetary and non-monetary, I would say investment in equity investment is something which I would say is non-monetary in nature. And I would say investment in terms of debt investment is monetary. The amount of benefits which you will derive from a debt investments will be fixed in nature. You're going to get a fixed amount of interest on that investment. You're going to get a fixed amount of principal money on that investment. But when it comes to equity investments, the amount of dividends which will come out of the investment is not fixed. So typically, for understanding, I said generally, a financial asset is monetary. But I think I just gave you an example that if you got investments, equity and debt investments, they are considered to be, a financial asset from the point of view of financial instrument standard. But if you look at the classification in monetary, non-monetary, your investment in equity is non-monetary. But your investment in debt investments is going to be something which is monetary in nature. So I think it would not have been appropriate that we start using the word financial, non-financial, but that was just for ease of convenience. Right? I think good you asked that right question at the right stage. Right. I guess that answers your question, Shobham. Okay. So far, so good. I guess we are very well connected with the thought process we need to apply in step one. Now, I think let's give you the final version of my step number one. Then we'll add on a few things as well. We'll add some more things to the step number one flavor, but let's, I think, now make the notes. So let's give you the final version. Till now, we were working on the exposure draft. Now I am giving you the final version of the step number one. So you can note it down. I'm going to give you the pending logics as well. So we are looking at the step number one. And in step number one, we are looking at the definition. And we are looking at the recognition. So we're looking at the definition and we are looking at the recognition. So in this case, we go to step number A. These are the sub-steps. We go to the step number A. So the first question we're going to put across is the expenditure? Is the expenditure related to negative list? Is the expenditure related to the negative list? Underline the word negative list. And I'll give you the negative list as well. But before that, let's give you a yes or no. So if you say, yes, it is a part of the negative list, then outrightly it is revenue. It's revenue expenditure. And if it is no, then you need to go to the step number B. Now let's make a list of the negative items with logics as well. And I'll give you the para numbers also for your reference later. So I think let me make a summary list. I'll give you the para numbers also, though para numbers are not necessary. Don't write the wrong para in the exams. If you know the correct one, then only write the paras, otherwise not. So let's take the particulars column. Let's take a column of particulars. This is the negative list. And let's give you a number, para number reference as well. And then I think we'll give you the logic as well. Why does the standard say that this item of expenditure is not to be reflected as an asset in the balance sheet? So the first one is supposed to be internally generated goodwill. The first one is supposed to be internally generated goodwill. And the reference is the para number 48, and the logic is that it is not identifiable. The logic is it is not identifiable, fails the definition characteristic itself. And I think just for a safety side, let me make a mention that we're looking at internally generated goodwill, not purchase goodwill. So if there is a purchase goodwill, it can definitely be reflected in the balance sheet as an asset. So we are focusing only in terms of internally generated goodwill. That is the negative list one. Let's take you further. Then the second item which is there is supposed to be the research phase expenditure. The second is the research phase expenditure, and that is the para number 54. And would you like to tell me what could be the logic in terms of a research phase? If the company is working under a research phase, what do you think could be, the factor which is not getting met? Well, I would say the future economic benefits are not probable. It'll be difficult to prove that the economic benefits will arise, and it's got a more than 50% chance because we're still under a research phase, and it'll be difficult to prove the concept of the economic benefits being probable in nature. Right, so in this case, that's the logic. Then number 3. The third one is the development phase. The third one is a development phase, and for your reference, the para number 57. But it's not exactly a part of the negative list, so I think I'll just like to make a mention as well that this is not exactly a negative list. So we can say only if any one or more conditions out of 6 conditions fail. So it's not exactly a negative list. We are saying that if you fail to meet any one or more conditions out of 6 conditions, then it is there. So we can say the logic is failure. Any one of these conditions, then it would be a case of negative list. We are yet to see those 6 conditions. I'll very shortly, after I'm done with the notes, I'll come to those 6 conditions also with you. Okay, then let's go to the item number 4. And the item number 4 is in terms of internally generated brands, couple of items. So we've got internally generated brands. So internally generated brands is one item, and then we've got methods. Then we've also got customer list. Like for example, over a period of time, you are able to collect the contact numbers, the details of the customer. They're all saleable items, but cannot be reflected in the books of accounts. The customer list, for example, publishing titles. So we've got publishing titles and say similar items. So I think I'll make a mention of similar items, market share. So if you've been able to develop a market share over a period of time, so the para number is 63. And would you like to make a guess in terms of why does the standard prohibit the para number 63 items, internally generated brands, customer list, publishing titles, market share? Well, in this particular case, the cost cannot be measured reliably because when you are developing the business as a whole, you would be able to create all these items. It will be very difficult for a company to identify that, what has been spent in terms of, creating these intangible assets. So the cost cannot be measured reliably. That's the logic. The cost cannot be measured reliably. So we can say the reliable measurement criteria fails in this case. So if you get any of these items, you can easily, tell the examiner that the logic is that you cannot measure the cost on a reliable basis. And then we've got a fifth item, and that is on a couple of items in para number 69. And we've got like preliminary expenses. We've got like preliminary expenses, what we're calling a startup cost. Then there is advertisement and promotional activities. There is advertisement and promotional activities. Then there is any kind of relocating cost. Any kind of relocating cost incurred. This is all a list in para number 69. And certain items will have a different logic. Like, for example, if you look at the preliminary expense, or if you look at the advertisements and relocating, well, in this case, you can say the future economic benefits are not probable. We will not be able to prove that future economic benefits are probable, because if you advertise, you can never be pretty sure that economic benefits would arise. If you, for example, relocate, you cannot say that the economic benefits will increase. And in terms of training, the standard makes it very clear that the control is missing. You cannot control the employee from leaving the job. So even if you've trained the employee, the skills might increase, the economic benefits would increase, but the control is missing. Because he can at any point of time leave the job. You cannot control him, and you cannot say that you retain him. You might sign a bond with him, but then the bond is also, you can pay a certain amount of penalty and exit. So the control factor is lacking in those particular cases. Okay, so there was something which I wanted to give you on a training part as well. So I think let me give you that clarification as well. So I think before I go to the step number B, let's, I think, give you a little more insight in terms of the training cost. There has been some very interesting inputs which are given in the education material. And I think let's give you a little insight in terms of the training cost. And this will also connect you to certain other standards as well. Well, I'm going to take now 3 situations, and I'm going to give you the inputs on a training cost. So this is a little clarification which I'm giving you based on what the education material is given. And there has been one of a very interesting questions on the training aspect, even in terms of RTP. Now, when I'm looking at training, I'm looking at 3 kinds of situations. One is you train an employee. So one of the situations I'm looking at that you train an employee. This, and so that you enhance his skills. So you train the employee where the objective is to enhance his skills. That is one kind of situation. The second is you train an employee, and you train the employee not for the purpose of enhancing the skill, but you are training the employee so that you can fulfill a particular contract. So that you can fulfill a particular contract. So that you can fulfill a particular contract. So I'll tell you, I'll give you more insights on this, but you can fulfill a particular contract. Sometimes, you may get certain contract from your customers, and the employees may not possess that kind of skill. So you want to basically incur a cost so that you can fulfill a particular contract. So they are already trained employees, but a specific kind of training needs to be given to them so that they are able to fulfill a particular contract. And let's say you hire a skilled person. Or let's say, for example, you hire a skilled person altogether. Like, for example, these days, that in IPL, many companies would, procure players who have already possessed the necessary skills. So you're not training them. The person you hire is already a skilled person, and you may pay a certain lump sum amount in order to get the benefits of the skill he already possesses. So I think just to give you now a clarification regarding these three situations, now let me take them one by one. If you're looking in terms of incurring a training expense to the employee for the purpose of enhancing the skill, we've already seen that para number 69 of the standard prohibits the capitalization. It is undoubtedly revenue in nature. The para number 69 of the standard is very clearly said that if you're incurring a training expenditure, we cannot say that in this case you control the employee. So the control factor is lacking and this cannot be capitalized. Now, let's come to the second one, that you train the employee to fulfill a particular contract. Now, hear me carefully. When you're looking at training the employee to fulfill a particular contract, here comes into play Ind AS 115. Here comes into play Ind AS 115. Ind AS 115, which talks about revenue, talks about a situation that when a company incurs a training expenditure in order to fulfill a contract or in order to obtain a contract, it will be eligible to capitalize that expenditure as an asset in the books of accounts, provided other Ind AS do not prohibit. So the reason, there was a very interesting question, which a clarification came in the education material, that a company is going to incur a training of the employee, and this is for the purpose of, fulfilling a particular contract. Ind AS 115 very clearly says that if you incur a cost to fulfill a cost, you're training the employee of the company, and it's a cost incurred to fulfill a contract or to obtain a contract, it can be capitalized. But the language in Ind AS 115 is very clear, provided other Ind AS do not object to it. Now, when you look at the cost to fulfill a contract, you cannot apply 115. You need to first of all go to Ind AS 38. Since Ind AS 38 in journal has very clearly said that training cost is something which cannot be capitalized, it doesn't make a difference what is the purpose of the training. If the purpose of the training is to enhance the skill of the employee, Ind AS 38 says no. It doesn't say that only this kind of training expenditure is something which is revenue in nature. So if you're even training an employee to fulfill a particular contract or to obtain a contract, before you apply Ind AS 115, you'll have to take the guidance in terms of Ind AS 38. And if I apply the guidance in terms of Ind AS 38, it very clearly says it's a revenue expenditure. So even if a company incurs a training to obtain or fulfill a particular contract, the triggering standard is not Ind AS 115. So the triggering standard in this case is again Ind AS 38, and this expenditure would also be treated as revenue in nature. Now comes the interesting one, that is number 3. If a company hires a skilled person who already possesses the skill, I am not doing any kind of training on that person. And in this particular case, you are eligible to capitalize the amount. You would be making a payment to the other person. A lump sum amount is paid to this particular person, and you will also have a control. Because in this particular case, when you hire a player, let's say a football company, a football player is hired or a cricket player is hired, the company will have the right to restrict the player from playing for other teams as well. So the control factor will stem out. So in those particular cases, we can definitely say that yes, this amount can be capitalized. So the employee, being a human resource, cannot be capitalized as an asset in the balance sheet. The training money which is spent on the employee cannot be capitalized in the balance sheet. But if you're already hiring a skilled person, and that particular case, you are going to be eligible for capitalization. Because if you look at the concept of the 5 parameters as well, identifiability will be present. Because you have hired the person specifically, and more so when you hired the person, I think let's give you a little more insight on that. Even if you want to evaluate this from the 5 parameters perspective, and if I want to just make a walkthrough, I would say, okay, let me first of all see that is it identifiable. And if you remember earlier, when I was doing the discussion on identifiability, I very clearly said that if there is a contractual or a legal right, the intangible asset stems out of legal or contractual right, identifiability is always met. So the player must have been hired by way of a contract, so identifiability will be met. If you look at the future economic benefits, I think generally it'll be easy to prove that if you have hired a player with the necessary skills, he definitely possesses those kind of skills where the future economic benefits are probable and they will vary. As many matches you would play, as much economic benefits you would derive. So future economic benefits would come. The control factor is also easy to prove because in this particular case, you will get the right to restrict the players from playing other games. He will not be able to play for the other teams as well. So the control benefit would come. Number 4, without physical substance, the skill of the employee is something, the skill of the player is something which is definitely intangible in nature. And number 5, if you're looking in terms of the cost can be measured, I have paid a certain amount of money to the player. And if I paid a certain amount of money to the player, I can definitely reliably measure the amount which is incurred as well. So I think this clarification is important that if a company is going to hire a particular player with the necessary skills already which he possesses, the money which you're going to pay to that particular player is something which is going to be capitalized in the books of accounts. Okay, so far so good. So I think I've now given you the inputs in terms of the negative list with all the logics as well. And this was my step number A. So my step number E is that the expenditure relates to a negative list, and you've got the details of the negative list as well, all the 5 items in the negative list. Now I think let's take you to the step number B. And in terms of step number B, we need to identify the list of this item. And somebody said capitalize would mean that it will be an intangible asset as per Ind AS 38. Yes. And Marini, you said, so in case of training of staff, which will enhance the skill is resulting in increase in economic benefits, then why is it revenue in nature? Well, I would say yes, the economic benefits are definitely going to increase, but the main factor which is missing is the control factor. It might be still possible to prove that economic benefits will arise and there is a good probability of economic benefits coming in, but the main factor is the control. In terms of employees, you can never get a control. And if you don't get a control, then it cannot be capitalized, right? Okay, so now coming to the next step number B. And in terms of step number B, once you're able to zero down that it doesn't relate to a negative list, then we need to go to the step number B. And in step number B, we are looking at the definition and we are looking at the recognition parameters. So we're looking at the definition and the recognition parameters, and this is also 5 in number. So I think just a quick inputs on all these 5 parameters. Number 1, we need to prove that it is identifiable. So what does identifiable means? Identifiable means that it is separable. Identifiable means that it is separable, it is capable of being sold, rented, exchanged. And just a little note, which I gave you earlier as well, that if it arises due to legal or contractual rights, if it arises due to legal or contractual rights, so if it arises due to legal or contractual rights, we can say identifiability is, you can say, always met. So the moment you read in the question that there are legal or contractual rights due to which this intangible asset is getting created, it is undoubtedly met. The second one is the future economic benefits. So the second one is the future economic benefits, in which you've got 3 factors that they will arise. My Karan Arjun will come, and it has got more than 50% chances, plus the probability that Karan Arjuns are going to come is more than 50% plus, and the Karan Arjun will keep coming. So that was an interesting example to give you, that Karan Arjun will come. I always call the future economic benefits, nickname them as Karan Arjun, that they will come. The probability of their coming is more than a 50% plus, and they will keep coming. So they will vary, and the probability is more than 50%. Then the third factor is in terms of control, and the control requires any of the two parameters. Either you prove a legal ownership. So either we prove a legal ownership in this case, or we can say in this particular case, we are able to prove that there is a right to restrict others from use. There is a right to restrict others from use. There is a right to restrict others from use of the asset. So we should be either having a legal ownership, or we should be having the right to restrict others from the use of the asset. And then the fourth one and the fifth one, as we said, the fourth one, we're going to call this as the technical name. It is called the probability, without physical substance. I think I've taken this out here. So I think let me call this as the probability recognition criteria. I've shifted it out here. This is the probability recognition criteria. And the fifth one is without physical substance. As we said, it's purely intangible or predominantly intangible. And the fifth one is supposed to be the reliable measurement criteria. It is the reliable measurement criteria. So it is the reliable measurement criteria. So we should be able to measure the cost. The cost can be measured. The cost can be measured on a reliable basis. Right, so that is the 5 criteria to be kept in mind. The second one has got 3 inputs, or we can even take it as 2, because future economic benefits would arise is indirectly taken care that there is a more than 50% economic benefits coming in. Right, friends, so I think this creates a complete chain in terms of my step number 1. I think I'd now like to do some very simple questions with you before I give some polishing ends to my 2-step model in terms of step number 1, because there is more to give you in terms of these items. But I think before that, I am going to do some few straightforward questions based on whatever we learned so far. So I think let's take you now to the study material and let's have a look at a few questions with you. So I am now going to the study material. We're going to pick up a few questions with you, which I think you'll be able to answer very easily based on the learnings, what we've done so far. So let me first take you to the illustration number 1. Okay, so let's have a look, friends, on the illustration number 1, which is on page number 7.352. Let me write down the number. So we are looking at the illustration number 1 on page 7.352 of the study material. I'm looking at the illustration number 1, and I think you will be able to decide it immediately as you read the question. It says Sun Limited has an expertise in the consulting business. In years gone by, the company gained a 30% market share for its services business and intends to recognize it as an intangible asset. Is the action justified? Now, let me tell you one thing, friends. There is not always one logic of saying that the intangible asset is not to be recognized as an asset in the balance sheet. Like, for example, when we were looking at goodwill, we said that goodwill is not identifiable. That's one reason. Another reason that a goodwill, internally generated goodwill, is not reflected as an asset in the balance sheet is also for the reason that you cannot measure the cost on a reliable basis. So even as you look at the illustration number 1, it doesn't mean that this is the only reason that it would not be reflected in the balance sheet of the company. Now, we are already given that it does not meet the definition. It's not separable. So it's not identifiable. That is very true. A market share is something which is not identifiable. But can you also give me another logic which I gave you? That why a market share is not eligible for being capitalized in the balance sheet of the company? I'm sure you can give that. So what is the logic in terms of the inputs I gave you? Is it a part of my negative list? Is it something which is covered in my negative list? What do you say? Let's get that answers from all of you. This is going to decide a lot of things. So I think if you look at the notes very carefully, when I was giving you the items in terms of para number 63, when I gave you the concept of internally generated brands, I said similar items. And in terms of similar items, I very clearly said that this is a case, yes, it comes in a negative list. It is a case of, you can say, para number 63, a similar item. So you can say when you're looking at a market share, we can say there can be two reasons. So you could support your answer with two reasons. The reason number one, you can say that it's not identifiable. That is also one of the parameters, that it's not identifiable. You could also support it with another factor as well, that the cost cannot be measured reliably. The cost cannot be measured reliably. That is a second parameter as well. Wow, simple and straight indeed. So that was illustration one. Let's, I think, look at another illustration as well. Let's look at illustration number two. Company XYZ provided a training to its staff. I think the word training itself is quite indicative. So they provided a training to the staff on various topics like GST, Ind AS, etc., to ensure the compliance required by law. Can the company recognize such staff cost training as an intangible? And of course, the answer is no. And the reason that it's a part of my specific negative list as well. The para number 69 of the standard very clearly says that the trainings cannot be done. And I think this goes to you, I think, Manini, which you were asking. And it says, it is clear that the company will obtain economic benefits performed by the staff as it increases the efficiency. But it does not control them, because staff could choose to resign from the company at any time. So as we said, the economic benefits might be probable as well, but the important factor is the control factor would be lacking. Hence, the company lacks the ability to restrict others to access to those benefits. Therefore, the staff training cost does not meet the definition of intangible asset. So again, a part of my negative list as well. Okay, so I think let's have a look at another illustration. Let's look at illustration number 3. It says Pluto intends to open a new retail store in a new location in the next few weeks. Pluto spent a substantial sum on a series of television advertisement. I think you know this very clear. It's a part of my negative list. The para number 69 very clearly says that if you incur expenditure on advertisement, revenue in nature. The company is paid 8 lakhs for advertisement before 31st March X1. 7 lakh of this relates to the advertisements to be shown before March X1, and 1 lakh relates to advertisements will be shown in X1, April X1. Since March X1, the company is paid for further advertisements costing 4 lakh. So you can say the money which is being spent for the advertisements which will appear before 31st March would be revenue in nature. And the money which for the advertisement which will appear in April is something which can be taken as a prepaid expense for the time being. So it will not appear as an intangible asset in the balance sheet, but would appear as an advance in the balance sheet. And then it will be taken as an expenditure in the next year. Pluto is of the view that the cost can be carried forward as intangible. Since the market research indicates that the new store is highly successful, please explain and justify the treatment. I think I've already given you that the standard clearly prohibits you to capitalize this advertisement expenditure. Therefore, 7 lakh rupees, which relates to the advertisements appearing in March, is revenue. 1 lakh is a prepaid expense to be reflected in the balance sheet, and then it would be taken as an expense in the next year as well. Right, so I think this takes care of the input, friends, on the application of our first step, which I have given you. Okay, so far so good on this. So I think we are done with the main step number 1. And now I'm going to give you a break first before we do some polishing ends to this first step, which we have done. So I think let's give you a 10-12 minutes break, friends, at this stage, and then we take forward the journey. So enjoy your break at the time, and I see you, friends, back after the break. हाँ जी, ब्रेक लगा दीजिएगा। Welcome back, friends. So I hope you had a good mental rest. So we've learned the aspect of step number one out of my three-step model, which I gave you. And we've seen the step number one in terms of two sub-steps with you. One is we've seen the application in terms of the negative list. And if it's not a part of the negative list, then what 5 parameters we are required to meet. Now, what I'm going to do, I'm going to take you a little bit further, and we're going to now look at things from a little different perspective. We're still on the step number one. I'm not on the step number two right now. And I want to look at these intangible assets from a little different perspective so that you get a little more finer edge in terms of, doing questions. So what I'm going to do, I'm now going to give you a thought process, and then we'll add on some more elements to you. Well, when I look at intangible assets, I believe we can segregate the intangible assets into 3 different categories. So I'm dividing the intangible assets into 3 broad categories. And one of the category is that the intangible asset is internally generated. So one is that it is internally generated. The second is that the intangible asset is being acquired separately. So the second perspective we can see is that they've been acquired separately. Now, when I say that they've been acquired separately, let me tell you that it's not a part of a business combination. It's an individual acquisition. So when I say that they've been acquired separately, it is supposed to be an individual acquisition. It is supposed to be an individual acquisition. Now, let me tell you, friends, one thing in advance. Now, the discussion, what I'm doing with you is slightly complicated, but trust me, it's very interesting. And it will definitely give you an edge in terms of understanding the parameters which are required to be met before you can capitalize an item as an asset. So I think once I'm done with my discussion, as I promised to you initially, I'm going to make a chart to you at the end of my discussion, wherein I'm going to broadly, make a chart on these parameters only, that if you've got assets which are internally generated, then what is the status? And if you've got assets which are acquired separately, but they're acquired separately individually, not as a part of the business combination. And the third is that they're acquired as a part of a business combination. They're acquired as a part of a business combination. Now, you would be studying Ind AS 103 later, and when you study Ind AS 103, you'll be coming to the aspect of a business combination. Now, one thing I would like to pinpoint at this particular stage, which I'll be coming to it later again, but I think it's the right time to give you something at this stage. Though I'm talking in terms of step number 2, not in terms of step 1 at the moment. So when you say that an intangible asset is recognized initially, it is always taken at cost. But when an intangible asset is acquired as a part of the business combination, Ind AS 103 on business combination tells me that you need to record it initially at a fair value. So the cost for the purposes of Ind AS 38 is going to be considered as a fair value at the time of acquisition. So if a company acquires intangible assets as a part of the business combination, their initial recognition takes place at a fair value. So cost for the purposes of the standard is considered to be a fair value only. So let me now change your thought process at this stage. So when you're looking at intangible assets, I am now looking at intangible assets from 3 different points of view. Either it is internally generated, or it is acquired separately, and it is an individual acquisition, not a part of any acquisition of a company. Or it could be a part of the business combination. Now, you would say, so why suddenly you are talking in terms of these 3 broad categories? Now, hear me very well. There are a total of, you can say, 5 parameters which I give you relating to definition and recognition criteria. So the standard has given us a total of 5 parameters. And if you meet the 5 parameters, then we say, yes, it can be reflected as an asset in the balance sheet. But there are certain additional considerations, or you can say there are certain clarifications which are given with reference to assets which are acquired separately, or with reference to assets which are acquired as a part of the business combination. So we are going to fine tune those 5 parameters. Not every situation you are going to look at the 5 parameters. I said that the first thing is that you look at, you can say you look at, first of all, the negative list. If it is negative list, then there is nothing to be seen and it's outrightly revenue in nature. The second input, I said that you need to look at the 5 parameters of definition and recognition. Now I'm doing a fine tuning. I'm saying that every time there is no need of looking at 5 parameters as well. Because if you look at the guidance given in the standard, they've given us some guidance which tells me that every time those 5 conditions are not required to be seen. Out of those 5 conditions, there are certain conditions which will automatically get met. So there will be no need to make a review of those 5 parameters. So in order to tell you in which cases the 5 parameters are seen and in which cases less than 5 parameters are seen, we're looking at intangible assets from this perception. We're looking at the intangible assets from the point of view that they are internally generated, or they are acquired separately, or they're acquired as a part of the business combination. Okay, so I hope my thoughts are very clear that why I'm looking at these 3 categories, because I want to fine tune the 5 conditions of definition and recognition given to you, because those 5 conditions are something which is not to be tested every time. So after we get the understanding of these 3 kinds of intangible assets, we'll come to know that in which cases all the 5 conditions are to be seen, in which cases maybe 3 conditions are to be seen, or maybe no condition is to be seen, whatever the case might be, right? Okay, now I think let's take this further. Now, when you're looking at internally generated assets, there is a misconception which people have got. Many people believe that if it is internally generated, it is never capitalized in the books of accounts. No, there is a specific prohibition with regard to internally generated brands and other items. But it's not that any intangible internally generated asset cannot be reflected in the balance sheet. So I would say, if you're looking at internally generated assets, intangible assets, I would put them in 3 broad categories. I would say, if you're looking at the goodwill, internally generated goodwill, which we saw in terms of para number 48, it cannot be shown as an asset in the balance sheet. Then we also saw that in terms of internally generated brands, etc., the focus is on the word internally generated. The focus is on internally generated. If you've got internally generated brands, etc., then we've seen in terms of para number 63 that this is also not reflected in the balance sheet. Now, if you look at internally generated assets other than 48, other than 63, I would call this that you are internally generating them on the basis of R&D. So you are basically generating these intangible assets on the basis of research and development. And when you are under a research phase, then we've already seen that if you are in a research phase, then para number 54 very clearly tells you that it's revenue in nature. And if you are in a development phase, then we said that there are a total of 6 conditions given in para number 57. And I'm yet to look at those 6 conditions. So there are not 5. There are not 5, but there are going to be 6 conditions to be seen. And these 6 conditions are, maybe they could match with these 5 conditions or not, we'll see. But if it is a case of a development phase expenditure, then you need to look at the 6 conditions and not the 5 conditions. So I think let's do one thing. Let's first have a look at these 6 conditions on a development phase. Before we come to the separate acquisition and a business acquisition, let's, I think, look at the 6 conditions of a development phase. So I am now taking you to the 6 conditions of the development phase. That what are those 6 conditions? And I'm pretty sure you've done those 6 conditions even at your intermediate level when you did accounting standard 26. But I'm going to give you a new flavor in terms of the 6 condition. Now, when I look at these 6 conditions, I look at these 6 conditions as 2 plus 2 plus 2. I look at these 2 conditions, 6 conditions divided into 2 plus 2 plus 2. Now, I think let me give you a story with which you are going to easily, logically in the development phase. So we are focusing on the 6 conditions which are given in terms of para number 57. I remember a long time back, many years back, I remember, a father and son coming to me. The father was a chartered accountant and the son had just passed his class 12th. And the father told me that, I want my son to become a chartered accountant. And I looked at the son and I asked him that, do you want to be a chartered accountant? And he totally kept silent on that agenda. So when the father said, I want my son to become a chartered accountant, I looked at the son and asked him that, you want to become a chartered accountant? And he kept silent and started looking at his father. Then I asked another question to the student and I said, how many marks did you get in your class 12th? And then he suddenly said that I got almost like 96, 97 marks. I don't remember the exact marks, but he said I got almost like 96 marks in my class 12th accountancy. So I could make one thing very clear. There are always 2 important elements for success in life. Trust me, this is what I'm telling you is given in Ind AS 38, but this is also a very generic formula for a success in life. I always tell people that there is something what we call intention. I have the intention to become a chartered accountant. It's very important that you must first of all, intend doing something. Intention is very important. It's the first step towards achieving any goal in life. And the other factor is supposed to be an ability. So both the factors are equally important. I will not say that if you've got the intention with no ability, I don't know if you become a CA based on that or not. And I don't know if you've got the ability and no intentions, whether a person would become a CA or not. But when I was asking the 2 questions to that student, what was coming to my mind is that when I asked him the first question that, do you want to become a CA? I was looking at his intention. And when he looked at his father, I could see that the is more of the father that he becomes a chartered accountant. And I think the intention was missing in that case. But when I asked his marks, I was actually looking at his ability. And when I looked at the ability, he's got a score of 96 marks in the exams, which could prove that yes, ability is definitely there. But let me tell you that you need a blend of both the factors in life. When you're doing this particular course on chartered accountancy, I'm pretty sure you will agree with me that the intention and ability both are relevant in nature. You've got the intentions that, yes, you want to become a good qualified chartered accountant, and you also have the ability in terms of achieving that goal. So intention and ability are 2 very important factors. And even para number 57, very clearly tells me that intention and ability needs to be seen, which means that we need to first of all see that if the company is in the development phase, in that particular case, if you are under a development phase, you need to first of all see that the company has got the intention to complete the development phase. And number 2, you need to see that the company is ability to put or maybe use that intangible asset created. So the company should be able to, prove the intention to complete. The company should be able to prove its ability to complete. That is 2 important elements. Now, other 2 important elements, if we look at, is nothing, but trust me, it's nothing but the same recognition parameters itself. The standard says that the future economic benefits need to be probable in nature. The standard says that the future economic benefits need to be probable in nature, which is nothing but we just saw a little while back that this is nothing but we can say the probability recognition criteria. This is nothing but we can say it's the probability recognition criteria. So we should be able to prove that the future economic benefits are probable in nature. And the next one is that you can measure the cost on a reliable basis, which we just a little while back called it as the reliable measurement criteria. We call this as a reliable measurement criteria. So you can say the two conditions which are there are nothing but the two same conditions which are given as a part of the generic recognition criteria. So even the two conditions which are given in the development phase are exactly similar to the conditions which are given in the generic condition. Then there are another two conditions which are given in the 6 conditions. And one of the condition is very important, that there is going to be an adequate resources available. If a company is under a development phase, what is important is that we should have adequate resources, the financial resources available, the technical resources available. It is important that the company should have all adequate technical financial resources available, without which they will not be able to complete the development phase. So the adequate resources should be in terms of the technical resources. The resources should be in terms of financial resources. So we should be able to prove that the company has got adequate technical and financial resources, because intention is one factor, ability is another factor, but you should also have adequate resources to complete. And then another factor which is given in the standard is regarding the technical feasibility. Regarding the technical feasibility in this particular case, we should be able to prove that whatever you intend to develop is something which is technically viable, is technically feasible. You can actually say that yes, it is technically feasible. So if you're able to fulfill all these 6 conditions, then only the expenditure incurred in the development phase, mind you, is eligible for capitalization. Mind you, is eligible for capitalization. So since morning, you've been saying again and again that the expenditure is eligible for capitalization. Why are you using the word eligible? I think I'll now draw your attentions on that part as well. But I hope I am fairly clear with my first aspect of the intangible asset. So when I'm looking at the intangible asset, one category of intangible asset is internally generated. So if you've got internally generated goodwill, there is a specific prohibition in the standard. If you've got internally generated brands, publishing title, customer list, etc., the standard prohibits the same. But if you've got internally generated tangible assets, which the company is developing, and it all depends upon on what phase are we into. Are we into a research phase? Then it is revenue. Are we in a development phase? Then all depends upon the 6th condition. And I think now it's very easy to remember the 6 conditions. The 2 is intention ability. The 2 is the recognition criteria, which I gave you, the probability recognition criteria and the reliable measurement criteria. And the other 2 is adequate resources and the technical feasibility. So I think now you will find it a little more easy to keep these 6 parameters in mind, right? I guess so far so good. I hope you've been able to connect with the thoughts so far. Okay. Okay, then I think let's take it further. And I think Koshki, you said, Shobham, you said, so isn't more of a subjective checklist? Well, you may not get questions in the exam, where you would be technically required to make a little evaluation in terms of these factors. But there is a particular question which is given in the study material, where we can say a little inputs in terms of these 6 conditions are there. I'll not directly take you to that particular question right now, but it's given in the test your knowledge part, where we're given a last question in the test your knowledge, which is giving us a little flair of how these 6 conditions are going to be evaluated. But yes, you rightly said that these are subjective conditions. And I guess from the examination point of view, we may not be tested in terms of these 6 conditions, because intention, ability, as well as, the factor in terms of other things might be, yes, very subjective indeed. But yes, in a practical life arena, of course, unless and until all these 6 checklists are met, you will not be able to capitalize the asset in the balance sheet. Okay, this is now the phase 1. But before I go to the acquired separately and acquired as a part of the business combination, let me now come to the development phase. Why I'm again and again saying that it is something which is supposed to be, eligible for capitalization. Now, let me take an example, friends, on this to illustrate this position to you. So I am now going to take a little input further. Oh, sorry. So I'm now going to take a little input further, and we are going to first of all have a look in terms of why we are saying eligible. So let's look at an example, friends, and see this example very carefully. I'm creating a time scale in order to give you the concept of why a development phase expenditure is supposed to be eligible. Let's say this is the financial year April 20 and ending on March 21. And let's say this is as good as 1st April 21, and this is ending on March 22. Now let's consider that there is a particular date, let's say on 1st of November. Let's say on 1st of November 2020, the company was in R&D, research and development, and they met the 6 conditions on this date. So let's say the company met the 6 conditions on 1st November 20. Now, if somebody were to ask me at this particular stage, that what do we do with the expenditure? What do we do with this expenditure which is incurred before 1st of November? So I would say any expenditure incurred before the 6 conditions are met is undoubtedly revenue expenditure in nature. Now let's consider what happens to the expenditure which is incurred after 1st November when the 6 conditions are met. Now, this is what I said again and again, that I'm not saying that it will be capitalized. I said it is eligible for capitalization. Now, let's consider some figures. Let's consider the cost incurred by the company after the 6 conditions are met is, let's say, to the extent of 8 lakhs. So let's say the company incurred 8 lakh rupees after 1st of November 20. Now, what does the standard require me to do? The standard very clearly says that when you capitalize the amount of expenditure on a development phase, you are required to apply Ind AS 36. Ind AS 36 talks about the concept of impairment. Ind AS 36 talks of the concept of impairment. Now, I don't know if you're aware of the concept of impairment or not. I don't know, friends. Can you give me some inputs? Are you aware of the concept of impairment under Ind AS 36? That what does the concept of impairment mean? I think just a very basic knowledge would also do. If you're just having a very basic idea on what is impairment, that would also help. Okay, so when you said what is a technical feasibility? Well, technical feasibility is that it is possible what you want to do. Let's say, for example, I am developing some kind of a pharmaceutical drug which is technically not possible to achieve. Then in that particular case, we would say that you cannot recognize it as an asset. Okay, I think basics we know. Okay, wonderful. So Ind AS 36 tells me that no asset should be ever overstated in the balance sheet of the company. So it requires you to conduct an impairment testing and calculate what we technically call a recoverable amount. I'm putting it as RA. It says that we need to calculate what we call a recoverable amount. The recoverable amount indicates the maximum recovery which can take place from an asset. Now, once the recoverable amount is calculated, let's say it comes to 6.5 lakhs. So let me now tell you something very important. Impairment testing under Ind AS 36 is conducted when there are indicators of impairment. Impairment testing under Ind AS 36 is conducted when there are indicators of impairment, but in this particular case, no indicators of impairment is required. It's a mandatory impairment testing before you capitalize any expenditure incurred by the company on a development phase. You need to, on a mandatory basis, conduct Ind AS 36 and identify that the asset doesn't capitalize more than the recoverable amount. So this is an exercise which is going to be mandatory in nature. every time a company incurs an expenditure in a development phase, you'll have to first of all sit down and do an impairment testing on the balance sheet date to identify the recoverable amount. So that is the reason I'm saying that it is eligible for capitalization. Now, I think you can really appreciate the company incurred 8 lakh rupees, but the recoverable amount is 6.5 lakh. So the maximum amount at which the asset can be reflected in the balance sheet cannot exceed 6.5 lakh. The company will have to indirectly book an impairment loss to the extent of 1.5 lakh. So in my example, the company will book an impairment loss 1.5 lakh. So this is going to be debited to the profit and loss account at the end of the year, right? This is the reason why I'm saying it is eligible. Now let's take the position in the next year as well. Now imagine in the next year, in this particular period, the company incurred a further expenditure. There is a further cost which is incurred, and let's say the further cost incurred is to the extent of 3 lakh rupees. The company has already capitalized the asset in the balance sheet at 6.5, and if another 3 lakh is incurred, you can say the total cost is 9.5 lakh. Now here again, on a mandatory basis, on the second balance sheet date, that is on March 22, the company will have to conduct an impairment testing again on a mandatory basis. The company would again apply Ind AS 36, and when they apply Ind AS 36, let's say the recoverable amount of this asset, let's say comes to, let's say 9 lakh rupee. So I would not be able to show this asset in the balance sheet at more than the recoverable amount. So the balance sheet figure would now appear at 9 lakh rupee. And whatever is the excess of this 9.5 compared to the recoverable amount, you're again going to book an impairment loss to the extent of 1 lakh rupees in the profit and loss again in the next year. Sorry, 0.5 lakh, not 1 lakh rupee. The company is going to book a loss of 0.5 lakh rupees in the next year as well. Which means if an intangible asset is being internally generated and the company is in a development phase, you need to keep in mind that at the time of capitalization, you need to meet the 6th condition, 2 plus 2 plus 2. Once all the 6 conditions are met, then you would say, okay, I will capitalize this asset. But you cannot capitalize everything what you incur. You will be able to capitalize compared to the recoverable amount. You need to conduct a mandatory impairment testing at each balance sheet date and then decide that out of the amount incurred, what is supposed to be eligible for capitalization. The rest will be taken as an impairment loss. Until the asset is, ready, the development phase is complete, this impairment testing will be done at each balance sheet date to ensure that the asset doesn't appear in the balance sheet at more than what you can recover. I hope, friends, I am pretty clear with this example. What are the conditions? 6 conditions of a development phase. That is 1. And also a compulsory mandatory impairment testing to be conducted at each year end. Okay, so when we said carrying value is less than the fair value of an asset, then it needs impairment. Yes, you can say that. But we should not use the word fair value, because fair value is typically just one component of the calculation of the recoverable amount. When we're looking at the calculation of impairment testing, it is based on a recoverable amount because it considers not only the fair valuation, which we call is the net fair value, which you're going to get on sale, but it also considers the present value of the future cash flows arising from the use of the asset. But I think I don't want to get into all that. But I think the better nomenclature would be to use the word recoverable amount. Okay. I think let's do one thing. Let's, I think, pick up a small little illustration on this area from the study material as well. Let me first give you the larger thoughts in this case. I am discussing, friends, a total of 3 categories of intangible assets. And I'm on the first category, that if it is internally generated, I segregated the internally generated into 3 parts. I said if it is a goodwill, no capitalization. Internally generated brands, research and development phase, if it is research, no capitalization. If it is a development phase, meet the 6 conditions, do the impairment testing, and then decide out of the expenditure incurred what is going to be eligible. We're yet to discuss separate acquisition. We're yet to discuss a part of the business combination. But before that, I think let's do a question on a development phase with you in the study mat. So I am now going to take you to a small little question in the study material. This is on a development phase question. So I think let's have a look. This is given at the back on your test your understanding. And though there is a couple of questions on that, I think, okay, let's take the illustration number 8. Let's have a look at the illustration number 8 in the study material, which is on page number 7.367. Page number 7.367. So we are on page number 7.367. There is an illustration number 8. So let's have a look at how we're going to apply this concept in this particular case. So let me just read the illustration now to you. It says an expenditure on a new production process in X1, X2 is given. 1st April to 31st December, the expenditure is 2,700, and 1st January to 31st March, the expenditure is 900. The production process met the intangible asset recognition criteria for development on 1st January. Very clearly, it tells me the date when all the 6 conditions are met, that is January X2. So undoubtedly, 700 is revenue in nature, and 900 I would not say will be capitalized. Next time when you say, you're going to say that this is eligible for capitalization. Now, I think, let me ask you a question. He says the amount estimated to be recoverable from the process is 1,000. Is that the impairment testing conducted under Ind AS 36? Yes. And considering that the recoverable amount is 1,000, can I capitalize that entire 900 rupees? I'm pretty sure you can answer this question. So we know that 900 is the expenditure incurred after the cutoff date when the 6 conditions are met. And then we are very clearly given the recoverable amount is to the extent of 1,000. And we can undoubtedly say, yes, we will be able to capitalize the entire 900. Then he says expenditure incurred for the development of the process in the next year, X2, X3 is 6,000. And the asset is bought to use on March X3 and is expected to be useful for a period of 6 years. What is the carrying amount of the intangible assets on March X2 and on March X3? Also determine the charge to the profit and loss account for the year X1, X2. At 31st March X4, the recoverable amount of the process is supposed to be 5,000. Then he says, what is the carrying, and the asset was bought to use, it says, on 31st March X3 itself. And then it says, what is the carrying amount of the intangible assets on March X4 and the charge to the P&L for X3, X4 on account of impairment loss. Now, the focus is in terms of 3 dates. He's asking you the information for the year ending March X2. He's asking you the information for the year ending March X3, and he's asking you the information for the year ending March X4. So I think the good thing would be to make a time scale, look at the movements of what is happening on each date, and then answer the question. So let's begin. Let me first of all create a time scale, and then on that basis, we're going to start the question. I'm dividing this in 3 parts. So I am given this thing started in X1, X2. So this is the year X1, X2. Then this is the year X2, X3. And then this is the year X3, X4. So this is, you can say 31st March X2. And this is 31st March X3. And this is 31st March X4. So we've got 3 focus dates as far as the balance sheet is concerned. Now let's load down the data which is given in the question. It says the production process met the recognition criteria on 1st January X2. So the date when we met the recognition criteria is 1st January X2. So I think undoubtedly the expenditure incurred in this part, which is given in the question 2,700, is undoubtedly revenue in nature. So 2,700 is undoubtedly revenue in nature. This is going to be debited to the profit and loss account. This is not an impairment loss. This is simply an expenditure which is to be taken in the P&L. Then 1st January to 31st March, the company incurred another 900. So the expenditure incurred in this portion is 900. I will not say it's capitalized. I will tell that it is eligible for capitalization. We will say that it is eligible for capitalization. So what do we do for the eligibility part? We apply Ind AS 36, a mandatory application of Ind AS 36, and we consider what is the recoverable amount. And we are very clearly given that the recoverable amount estimated is 1,000. Now, since the recoverable amount is more than 900, that indicates that there is no impairment loss. So we don't need to book any impairment loss as per Ind AS 36. So in the balance sheet of the company, the intangible assets will appear under the head intangible assets under development. If you look at the Schedule 3, Division 2, you've got after in the intangibles a head which is called intangible assets under development, and it would appear under the head intangible assets under development. Pretty simple. Let's take it further. Then he says expenditure incurred for development in the year X2, X3 is 6,000 and the asset is brought into use on March X3 and the life is 6 years. So in this particular case, another 6,000 is incurred in the next year. So in this year, we incurred another 6,000 rupees. Now, I am not given any information with reference to the, you can say, impairment testing. So we can very conveniently take a presumption that as per Ind AS 36, it seems that's an assumption that the recoverable amount might be greater than the carrying amount. So there is no impairment testing which is being done. So in this particular case, we will simply capitalize the figure in the balance sheet. 900 was the value of the asset earlier, and another 6,000 is incurred. So we can say the total value which would appear in the balance sheet of the company is 6,900. Pretty simple and pretty straight. So what is the carrying amount of the asset on March X2? Done. March X3? Done. Determine the charge to the P&L for X1, X2. You can see the smart requirement of the question. He is asking you the amount to be taken in the profit and loss for the year X1, X2, but he doesn't say what is the profit figure, P&L figure to be taken in X2, X3, because there is nothing to be taken in the profit and loss account in the year X2, X3. Then he says on March X4, the amount estimated is 5,000. Now, a little careful, friends, at this stage. Now the asset is brought into use, though I have not given you the aspect in terms of depreciations or amortizations, but I think you can do it with a normal logic as well. So we can say now onwards, amortization will start taking place. The asset was ready for use on March X3. So we will start our amortization process based on a 6 years life. So if I would calculate the annual amortization in this case, my annual amortization in this particular case is 6,900 is the value of the asset and 6 years is the life of the asset. So we could take an annual amortization, 6,900 divided by 6, that works out at 1,150. So we can get now the book value of the asset at the end of the year X4. So let's get the book value, or you can say the carrying amount. So out of 6,900, we reduce the annual amortization of 1,150. So this works out at 5,750. So before you do the impairment testing. And now, since the asset is ready to use, let me tell you, at this stage, impairment testing is not mandatory, but it's only if the indicators of impairment are present as per Ind AS 36, impairment testing will be done. I put this again. On March X2, when it was under development, it was mandatory impairment testing. On March X3, when it was still ready to use, it was mandatory impairment testing. Or you can say it was ready to use, but still at the time of capitalization, impairment testing will be done. On March X4, it's not a mandatory impairment testing. On March X4, we are only saying that impairment testing needs to be done if there are indicators. Since the question is giving you the information that the recoverable amount was estimated, it means that there must have been indications and we must have conducted an impairment testing. So my recoverable amount is given to me, it's 5,000. So we know that since the recoverable amount is 5,000, the asset in the balance sheet cannot appear at more than 5,000 rupee. So the asset in the balance sheet would appear at 5,000, and we're going to put an impairment loss as a debit to the P&L. 5,750 versus 5,000, 750 is the impairment loss, which is going to be debited to the profit and loss account of the company. This is the impairment loss. I think if the focus is clear, I think this illustration would have been absolutely clear. So what is the carrying amount of the intangible assets on March X4? Done, 5,000. And the charge to the P&L on account of impairment loss is done. So this is the status of how you can present the answer. And I have done it on a time scale, but you can reflect the answer in this manner as well. Okay. So this part gets over, friends, on that. I hope I'm pretty clear on this. Okay, now I am coming to the other two parts with you. So focus has been on internally generated assets. Now I am going to change my focus to the other two categories of asset. And that is if it is acquired separately or if it is supposed to be acquired as a part of the business combination. So I'm going to look at this part now, and I'm going to look at this part now. Now, there is a certain guidance which is given in the standard. So we are now going to take you to certain paras which are given in the standard. So what I'm going to explain you right now, I may not be able to completely give you the image. Certain things will be pending. No worries. I'll be able to consolidate them in the next class as well. Don't get worried on that. But let me now give you some additional inputs given in the standard for separate acquisition and acquired as a part of the business combination. So in this case now, I am going to take you to one or two simple paras which are given in the standard. And I'm just going to connect you to those one or two paras. They are also given in the study material, but I just am looking at, for convenience, the text of the standard here. Now, I want you to first of all look at the para number 25. And the para number 26, you can see the heading. It says a separate acquisition. It says very clearly a separate acquisition. Normally, the price an entity pays to acquire a separately intangible asset will reflect the expectations about the probability that expected future economic benefits will flow to the entity. The para number 25 in simple words is telling me that if you pay a price to acquire, a payment of a price to acquire is indicative that future economic benefits will flow. It is probable. In other words, the entity expects that there will be inflow of economic benefits, even if there is an uncertainty about the timing or the amount of the inflow. Therefore, the probability recognition criteria in para number 21A. Para number 21 is the recognition criteria, which I gave you that there are two components of that criteria. One is what I call the probability recognition criteria. It says the probability recognition criteria is always considered to be met. Wow. Now, I think, friends, at this stage, I have a small little question coming to my mind. So can I say in terms of acquired asset, he is telling me that out of my 5 parameters, remember, there was a second parameter which said future economic benefits will arise. The future economic benefits will have a 50% plus chance and they will vary. Is he indirectly telling me that this 2B is met? Is he indirectly telling me that there is no need to evaluate 2B? This is always going to be met. So we can say indirectly 2A will be always met, 2B will always be met. The only thing which you need to prove is that the economic benefits will vary, right? You don't need to prove that the economic benefits will arise or the probability of occurrence is more than 50%. It is implied the moment you acquire an intangible asset. But yes, we'll have to prove that the economic benefits will vary. This is what is given in the para number 25. Then he says in para number 25, after this, I think, let me take it further. This was one thing. And then it says in para number 26, in addition, the cost of a separately acquired asset can usually be measured reliably. Is it talking about the reliable measurement criteria? It says the cost of the separately acquired asset can usually be measured reliably. This is particularly so when the purchase consideration is in the form of cash or other monetary asset. Now, hear me well, friends. Hear me well at this stage. He is telling me that if you acquire the assets, and typically if the acquisition is taking place by way of cash, you are acquiring an asset and paying a consideration in cash. And if you remember, there was a fifth condition which I gave you, and that is that the cost can be measured reliably, which means that we are looking at the reliable measurement criteria. He says the reliable measurement criteria is usually met specifically when the consideration is paid in terms of cash. Oh, so that means my mind is now thinking on the two aspects. Watch me, friends, very carefully on this. If you've got an intangible asset, which is acquired for cash, you don't need to look at the condition number 5. You don't need to look at the condition number 2A and B. But let's say, for example, an intangible asset is acquired by way of exchange, because he says that if the consideration is in cash, then this condition is met. But let's say if you've acquired an intangible assets by way of exchange, then I guess the condition number 2A and B will be met and not the condition number 5. The condition number 5 will still need to be evaluated, because if the consideration is in cash, we can say it is reliably measurable. But if the consideration is not in cash, then it is difficult to say, but I think it needs an assessment. Am I clear, friends, at this stage? I guess my thoughts are very clear at this stage. Yes, great. So I think we've reached an input that, when we're looking at a separate acquisition, the list gets a little narrowed down. The list of parameters in terms of evaluating whether it would be reflected as an asset in the balance sheet or not will get slightly narrowed down. When the acquisition is by way of cost, you don't need to look at condition number 2AB. You don't need to look at the condition number 5. But if it is a case of exchange, you need to look at the condition 5, but you still don't need to look at condition number 2A and B. Okay. Now, I think I also want to take you to the additional considerations given if the intangible asset is acquired as a part of the business combination. So I think let me take you further. And there is a very interesting inputs given in para number 33 and in para number 34. In this particular para. I'm going to read in between this particular paragraph, and let's first read. In accordance with Ind AS 103, if an intangible asset is acquired in a business combination, the cost of that intangible asset is the fair value. A little while back, I gave you that if the intangible assets are acquired as a part of the business combination, I very clearly said that they are recognized at a fair value. The cost for the purpose of initial recognition is considered to be a fair value. And then it adds on, the fair value of the intangible assets, blah, 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 blah. It says, indicates the expectations about the probability that economic benefits will flow. In other words, we can say the probability recognition criteria is always considered to be met. So which means that if you acquire intangible assets in a business combination, we don't need to make any evaluations on the probability recognition criteria. The 2A and B is always met. Wow. Then he adds on in the para number 33. If an asset is acquired in a business combination, is separable or arises from contractual or other legal rights. if it is separable, or it arises from contractual or other legal rights. It says sufficient information is present to measure the fair value. Thus, the reliable measurement criteria is always considered to be met. Wow. Which means he is telling me in terms of acquired intangible assets, which is acquired as a part of the business combination, can I say the condition number 2, future economic benefits, that it is arising, it is probable, always met. No need to make any evaluations. The condition number 5, that the cost can be measured on a reliable basis, is always met. So we can say effectively, we would have to look at into 3 conditions only. The clarification given in the standard puts us that in order to consider whether the out of the 5 parameters, we can say effectively you need to meet only, you can say, a total of 3 parameters in all. Right, friends, I hope I am clear. Don't worry, we'll be consolidating this input further. We yet to work a little more on this, but I hope so far so good. You've been able to catch up with the concept. Now I think it's time. First, I am going to do a little consolidations of things with you. So I'm going to first of all consolidate our learnings today and then give you some MCQs for the day. But I hope I've been able to change your perception in terms of looking at this beautiful standard. So I think you've got a new look in terms of how you're going to look at the standard on intangible assets. Okay. Let's begin the journey. Let's do a little mind mapping at this stage. Not getting into much nitty-gritties, but just a little mind mapping, friends, at this stage. So let me just consolidate our learnings, what we have done in terms of the standard today. So let's, I think, consolidate the picture. Well, I started off with a 3-step model. I started off with a 3-step model in terms of things. I said the first is that you need to look at that the definition and the recognition parameters are met. And later did I create a list of 5 parameters. And then I said, you need to go for a measurement, and we'll see that initial measurement takes place at cost. But in certain cases, the initial measurement is taken a fair value. We yet to discuss step 2. And there is a step number 3. We need to consider the amortization. We are yet to discuss the step number 3 as well. Today, our concentration has been on step number 1 only. And in terms of step number 1, I gave you certain sub-steps to follow. I gave you certain sub-steps to follow in this particular case. And I said, you've got a sub-step number A and you've got a sub-step number B. When you look at the sub-step number A, you need to first of all look at the negative list. And in terms of the negative list, I have given you a total of 5 items in the negative list. The one item which I gave you was a case of internally generated goodwill because it is not identifiable. The second one I gave you is a case of research phase in R&D because economic benefits are not probable. The third one which I give you is internally generated brands, methods, customer list, etc., because the cost cannot be measured on a reliable basis. The fourth one which I gave you was in terms of the development phase. I missed out. The development phase is something which is conditional on the 6 conditions. If the 6 conditions, any one fails, then it is a negative list. And the fifth one is comprising of your preliminary expense, your startup cost, your training, your advertisements, etc. And in terms of training, I've given you a lot of clarification as well, that if you train an employee, you cannot capitalize the expenditure. If you train an employee even to fulfill a contract, then also you cannot capitalize. But if you hire a person who's already a skilled professional, a skilled player, for example, then it is definitely capitalized in the balance sheet. So you look at and see that is the item a part of the 5 list or not. So if it is not a part of the 5 list, then you go to the step number B. And in step number B, looking at the definition and the recognition parameters, I gave you again a list of 5 parameters in this case. But I have now narrowed down the list a little based on permutation combination. We said if you're looking at internally generated assets, if you're looking in terms of internally generated assets, especially if you look at the development phase, then in those cases, we don't look at those 5 conditions. Rather, we need to look at the 6 conditions, which I gave you 2 plus 2 plus 2. Then I said that there are certain items which are acquired separately. And in this case, you can say effectively, you need to evaluate 3 conditions or maybe 4 conditions. Because depending the acquisition is by way of cash, then effectively 3 conditions. And if it is by way of exchange, then 4 conditions. And if it is acquired under a business combination, then again, effectively, you need to evaluate 3 conditions. I'm yet to do a little more work, friends, on this, because as I promised, I'm going to make a chart, of course, in the next class with you, wherein you will get all the permutation combinations of things. And then, what you can do, you can actually, pick up the illustrations in the study material and map up your questions in those charts as well. That would consolidate your learnings very well. Okay. Now, I think it's time to give you some MCQs based on that, but I guess so far so good. I hope all of you are pretty comfortable with the concept. And Kosh, you said para number 33 is not very clear. Nobody, I'm not yet done, as I still gave my disclaimer that I am yet to, give a finishing end to the stage. So don't worry. I'm not yet done. I'll be taking this trail a little forward more, and you'll get a complete clarity based on that. Just remember that, there is some additional considerations, which is narrowing down the list on the basis of which you evaluate whether the asset will be shown or not. So not every time we've got 5 conditions. Sometimes the conditions will get narrowed down. We will work upon that. Okay, now I think it's time to do some MCQ questions with you. And I think I am going to create my own questions and you can note them down. I'm not going to give you answers of those questions right now. We'll discuss these questions in the next class with you. So let's give you the questions. Can I say the negative list is got 4 items which are totally prohibited. 4 items which are totally prohibited, and it has got 1 list of item which is conditional. So my negative list, which is given in Ind AS 38, has got 4 items totally prohibited and 1 which is conditional. You know what I am saying. Next, number 2. The second one I'm looking at is that the definition and the recognition parameters, has got a total of 6 conditions as such. They've got a total of 6 conditions as such. I might have narrowed it down, but then there are practically, you can say, 6 conditions if you look at the definition and the recognition criteria. And number 3, can I see if you look at assets, intangible assets acquired separately, if you look at intangible assets which are acquired separately, not as a part of business combination, not a part of business combination, we can say the 6 conditions, the 6th condition gets narrowed down. I'm not saying to how much it gets narrowed down, but I'm saying it gets narrowed down. So instead of evaluating all the 6 conditions or effectively the 5 conditions, the list will get slightly narrowed down in this particular case. Number 4, if you're looking at the intangible assets acquired as a part of business combination, so if you've got intangible assets which are acquired as a part of business combination, the 6 conditions does not get narrowed down. The 6th condition does not get narrowed down. So the list doesn't get narrowed down in this case. You need to still evaluate all the 6 conditions. So this is my fourth question, and then finally another fifth question on this. So I think I've given you a blend of all the parameters, the negative list, the definition recognition, separate, and this. And then I think I'm going to give you another one. Can I see if you are in a development phase? If you are in a development phase, so if you are in a development phase, Ind AS 36, Ind AS 36 is applied if indicators of impairment are present. Ind AS 36 is applied if indicators of impairment are there. If indicators of impairment are present. So we will apply only if the indicators of impairment are there. So if there are indicators of impairment, then we would conduct impairment testing. I think you know this very well. What are the correct and the false answer? I'm sure I would have already got a couple of answers so far. Yes, I think I'm already getting some good answers on that. Great. But I think I'm not giving you the answers right now. So based on our understanding of the concept today, this is a list of 5 MCQs you'll try. I'll share the answers to you in the next class. And next class, we'll also be winding up with this particular standard. So our main concentration would be on the leftover portion of the step number 1, along with the concept of step 2 and 3. The step 2 and 3 is not going to be very challenging because if you've done Ind AS 16, many of the inputs, what we're going to discuss is going to be quite similar in terms of this standard as well. Right, friends, so let's see if you've got any questions to ask. Okay, I think, Koshki, you've given the correct answers, absolutely. So I think, yes, so I think it's time now to bid goodbye, friends, to you, unless you've got any questions to ask. Okay, so I think there is nothing more, I guess, coming in. Okay, wonderful indeed. So thank you, friends, on that note. So I take leave from you, friends, and going to see you in the next class. Thank you, take care, and goodbye.